Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, October 11th, and then we'll see how things look for Thursday, October 12th. In spite of things appearing to be escalating in the Middle East, you've got more parties being involved now with the whole situation that's going on there. The markets are still seeing a flight to quality as they go into bonds. They're considered to be the safest investments. And so as folks are getting into bonds, that's pushing prices up, which is pushing interest rates down. We're also seeing oil continue to drop. And so both of those together are giving some support to stocks going higher. Now, we're still trying to figure out, is this just some kind of a short-term bounce before we start to get set to go lower? You can suggest that on a historical basis, but we have to follow the charts to see what's really happening. On a short-term basis, we're starting to get more overbought. We have a lot of indications that we're getting extreme positive. Now, the list is the same as it was yesterday. We're just a little more so after Wednesday's session. So let's go back and talk about what happened. Right at the open, we did have a higher open, but we didn't get up to R1 at 43.83. We fell back down to the daily pivot at 43.61. We fell below the unchanged level and then actually drifted below 43.50. That was not a pivot level, just a round number. And we actually went a little bit below that. After the announcement came out or the meeting minutes were released, prices rose back above 43.50, the unchanged level, the daily pivot, and we closed at the previous intraday high. We set a high right after the open and then kind of made this big U shape and came right back to that intraday high going into the close. We were up 0.43% on below average volume. In our technicals, we're switching more positive in the short term, looking a little overextended. We're improving in the intermediate term, and we're still positive in the long term. And we're seeing this, and I'm not really quite sure what to call this. Some name will emerge at some point. But we have Israel and Hamas. That's how it started out. Now Hezbollah is getting more involved. And it's probably not a real stretch to know that Iran is behind both Hamas and Hezbollah. And we're wondering, is that going to escalate things? Because Iran and Russia are starting to team up with each other, something that's never happened before. Is that going to escalate the war in Ukraine? The U.S. has been supporting Ukraine. The U.S. is an ally of Israel. So is that going to change things going forward? We just have to watch it play out. Some comments. Bonds are being seen as a flight to safety after being oversold. They were just getting hammered last week, and this is pushing rates down as bond prices go up. Oil is continuing to decline at 83.75. We were just in the mid-90s a week ago. Small caps are having a couple of positive days, but they are generating a death cross since they're below their 200-day moving average. The micro caps are still near that new 52-week low. And here's our short-term overbought list where we have the CMB composite, the Stochc RSI, the Williams percent R, the CCI 14, the stochastics, and the force index. It's the same list, just a little more extended after Wednesday's session. The current scenario, and we're wondering, is this going to change at some point? We've added the whole Israel war to the whole mix, but it's still looking like the economy is stronger than expected and that the Fed will need to keep rates higher for longer, perhaps even raise rates. There's some news coming out of China that they could be having some real problems, especially in the real estate area, and that could have a real impact on an already weak economy. And then we're keeping an eye on oil prices. The dollar was up slightly, which doesn't seem to be giving much of a headwind right now to stocks. But interest rates going down, that's providing a tailwind and giving some support. We do have the 10 to the 5, which went back to being inverted again. The 30 to the 5 is still looking more normal. The other yield curves that we follow remain inverted. Sentiment is ticking up since we had a slight up day. We were at 32. We ended up being at 33. It's still negative, but showing improvement. Our trend is positive. The green line is crossing above the red line on both the short and intermediate term chart. But the ADX is declining, although it's above 20, so that's still a trend. It's a weakening trend since both charts show them dropping below their moving averages. Our bias is positive, and our momentum continues to be positive. The economic reports that came out, we had the weekly MBA mortgage applications index. It was up 0.6%. Last week, it was down 6%. The PPI, and this was the big one, and this is the first of the big inflation reports that are coming out this week. We were up 0.5%, more than the 0.3% that we had expected, but down from the 0.7% we saw last time. When you take out food and energy, we were up 0.3% month over month. They expected it to be 0.2%. Last time it did come in at 2%. Now, the market could have just tanked on this, but it decided not to. When you calculate that over year, it's 2.2%, well up from the 1.6% that we saw last time. When you look at the core PPI, it also ticked up to 2.7%, where it had been at 2.2%. Here's a chart showing how the mortgage applications are showing some improvement, but this is just a weekly number and it can kind of come and go as the wind. Here's looking at the final demand for PPI, where we are seeing it start to go back up. The blue line is the total reading, where the core line is the gold area right there. They're both turning back up slightly. When you look at it on a year-over-year basis with the goods, we're seeing that begin to increase back above zero where it had been declining. We're turning up slightly, but flattening out with the services. And when you look at processed versus unprocessed goods, where the processed goods are in blue and they bounce back up, the unprocessed, after they have been declining, are showing a bit of a bounce. Here's our chart just showing, looking back over the last 12 months, where we're seeing a bit of a bounce up now with PPI. Are we going to see that same kind of a thing with CPI? But on a rate of change going back 1 month, we did decline. And then looking at the core PPI, where it's still continuing to decline, both with the rate of change chart going back 12 months and on a month-over-month basis. We're down to the 4.59% level now. That's dropped from where it was, but we're still above that 4.02% level with the 10-year yield, suggesting that this still could be pressuring companies because they have to pay more to borrow money. Here's the intraday chart where we did have a little bit of a higher open. We set an initial high, and then we just drifted down as folks were waiting for the minutes to be released. We came down below the daily pivot, down below the unchanged level. Then the announcement came out, and we saw a bit of a bounce going back up. That could be seen as positive. Looking at the growth versus value chart, where the blue line is still above the red line, even though they're on different scales, they're continuing to show some improvement. And this looks to be stabilizing for now. In yesterday's video, this was a concern as I saw growth really drop off compared to value. And we were actually down in the overall ratio, where we have been seeing it really going up over the last month or so. Well, we seem to be hanging in there for right now, at least. And then looking at the end of day value, where we ticked up ever so slightly, we're starting to break out above previous levels. We're still in a longer term uptrend as well. Then we look at a discretionary equal weight ETF and a staples equal weight ETF. And at the bottom, we see where discretionary is outperforming staples. And it's not so much that discretionary is doing great. It's still in an uptrend, but it's not shooting to the upside. Its staples are really underperforming. And that's why we're seeing this ratio actually start to break out a little bit here. Also, another measurement of growth versus value, we're coming back to where we were at previously now. We're above all the lines in this rainbow. So this is showing some improvement. Looking at the condition of our trend, where the ADX is below its moving average. So that shows a weakening trend, but the ADX is still above 20. The green line is still above the red line, so we would default to positive. Seeing pretty much that same thing in the short term, a weakening trend, but still above 20. The green line is still on top. We're wondering if we're coming into the middle part of the month now, where typically this is when we see the VIX top out, at least on an average basis, but we didn't really see it shoot up all that much. We did see it go up, but it didn't really climb as high as what we've been seeing in the past. Is the spike still yet to come? Are we going to start to turn and go back down and push the VIX back up? Or are we going to follow historically what has happened, where maybe we've put some kind of a bottom in now and we're going to start to see the VIX really continue to decline? Looking at the Ulcer Index, it's showing that fear is decreasing. The VIX with the line chart is coming back down to the moving average after declining. We closed kind of near the bottom part of the bar and coming down to the moving average with the bar chart. Looking at the volatility of the VIX, where it was really spiking up probably before the announcement of the meeting minutes, where it really started to shoot down, and it ticked up just slightly on an end of day basis, but still below the moving average. We are continuing to go up with the VIX to VVIX ratio. This is longer term negative. The VIX to move ratio continues to decline as bonds and stocks are going up. So we're seeing volatility across the board start to dissipate. This is also positive. We're still seeing the equity put call ratio continue to decline. We never got much of an extreme reading nor any kind of real capitulation in the market. And we've bounced up to this level other times. So we'll have to see, is this going to give us some kind of really positive aspect that we can hang on to as it declines, or is it going to turn and go back up and give us another extreme reading? Here's a longer term look at that same chart showing when we tend to spike up with the equity put call ratio, and we didn't really spike up at this time anyway. The longer term equity put call ratio continues to advance. That's longer term negative. We are seeing a decrease in fear with this fear chart. We're seeing an improvement with the advanced decline line based on price, seeing a bit of an improvement based on volume, but we're still below the moving average. We are seeing some improvement, and it's not that we're seeing a real expansion in new highs, even though they're improving. It's more that we're seeing a lot less new lows, and so that's turning our 5-period and 10-period back up. That's switching back more positive. On a short-term basis, the advanced decline ratio, that's the blue line. We're positive where we're right at the midpoint with the red line. That's more intermediate term. This is something that's showing some improvement as well. Accumulation distribution, we're above the red line and advancing, and the red line is ever so slightly starting to turn back up. This is trying to measure the smart money. The Chaikin money flow has finally turned back to positive after it had been showing a lot of improvement. And so this is also suggesting that the smart money is still coming in and buying. We're still above the long-term trend channel, but we're below the 50-period moving average. And we are still above the 200-day simple moving average. And then on the bottom, volume is below average. So we're seeing that trail off just a little bit when we look at our volume indicator. The Stochk RSI remains extreme positive. The Williams percent R is extreme. The CCI 14 is extreme. The force index is still hitting this upper Keltner band. So that's extreme positive. And in the short term with our stochastics, we're extreme. We're turning positive in the intermediate short term. And we're also showing a lot of improvement with the long short term. The CMB composite is still above this black line. This is a line that I put here. There's nothing magical about it. It's just used as a reference point. But when we get to this high of a reading, it doesn't necessarily mean that we'll see a reverse, but we might start to see things at least slow down. Looking at our double and triple exponential moving average based on 20 periods, we're seeing both the green line and the blue line starting to turn back up. That's showing short-term improvement. And we're still above both the simple and exponential moving average with our moving average study. That's showing improvement. The Swenlin trading oscillator based on price and volume continue to be positive. The go-no-go system remains with the lighter shade of purple. The TTM squeeze is also showing some improvement. The balance of power is crossed above the midpoint and turning actually positive now. And we're coming up above the midpoint with our highest high, lowest low values. We want to hit this blue line and then eventually see the blue line turn back up if you're more positive. At the same time, we would likely see the red line continue to be flat. Now, we could come back down and drop below this midpoint, but that hasn't happened at least yet. The vortex, the red line and the green line are pretty much on top of each other right now. They're giving identical readings, but this is turning more positive. Since the red line was on top, it's showing a decrease. The green line is showing an increase. And if we see some more follow through, this indicator should turn over positive. The ease of movement crossed back above 0. That's also turning more positive. And the bullish percent index continues to bounce after giving us an extreme negative reading. We're still looking positive with the S&P McClellan oscillator. So our summation index based on price and volume continue to show a lot of improvement and are actually turning positive. The NYSE McClellan oscillator above 0 and advancing, that's positive. We're seeing a turn up with the NYSE summation index based on price and volume. The Elder Impulse system for the S&P remains positive with a green bar. We're seeing a bit of an improvement with our Arun indicator. After giving what you could say is an extreme negative reading, it's now starting to turn back up. We're seeing sellers decrease and buyers increase. That's why the oscillator is going back up here. When the green line crosses above the red line, that's when we would cross above the 0 with our oscillator. On balance volume continues to be positive. We're above the red line. The longer we stay above this, the more the red line should turn up. The Copic curve is generating a buy signal. The RSI based on 14 and 9 periods are above 50 and advancing. That's positive. We're turning positive now with our momentum. With the PMO going up, we've already crossed based on price and volume. Looking at our PMO studies, we're not quite extreme positive with the PMOs that are rising. We're turning positive with the buy signals, and we're also rolling and going back up with the PMOs that are above 0. The NYSE bullish percent index still below 50, so that's negative, but we are starting to show a bounce, which is suggesting more broad-based participation. The NASDAQ 100 bullish percent index actually ticked down a little bit. We're right at the 50 level, so we'll want to keep an eye on that one. The slope oscillator continues to be positive. The MACD is turning positive. All of our oscillators in the short and intermediate term are now positive. We're just about ready to see a crossover with our longer term oscillators. Looking at our 50-period double and triple exponential moving averages, we're coming right back up to this blue line. We want to be able to get above that if we're positive and then see these lines begin to turn back up. Looking at our regular 50-period moving average study, we're still underneath the exponential moving average, which is providing overhead resistance. The 100-day moving average study, we're right in between the exponential and simple moving averages. We're still above this pivot level on the price chart. Looking at our moving average tree, we are bumping into some overhead resistance at the 50-day exponential moving average. We're above the 20s now, so that's shorter term positive. If we can break up out of this and get above these other moving averages, that would turn things back more positive. We're still above the midpoint with our standard deviations chart. You're seeing all these purple areas start to at least flatten out, and the bottom ones are actually starting to turn back up slightly. The Chaikin oscillator continues to be positive. The money flow is just a little bit above 50, so that is now positive. The ultimate oscillator is positive. The parabolic SAR is positive with the dots underneath. We're still above this 100% retracement level with our short-term fib chart. We're still above the 61.8% retracement level with our longer-term fib chart. We're coming up outside of this little mini rainbow. The longer we can do that and even go up, the more these these color lines will start to turn back up. Yes, one of them happens to be blue. Then longer term with our trend line, we're still above this trend line going back to the October 2022 low. We were able to regain that, and that is positive. The special K chart, we haven't quite crossed over yet. We're right on top of the red line. If we see some upward movement, we might be able to avoid a sell signal here. If we see weakness, that might end up producing a sell signal. Looking at our 50-day moving average study, after getting extreme negative, is continuing to show some improvement. Also seeing some improvement with our 19-day exponential moving average of the advanced decline ratio. We almost got extreme based on price, and now we're going back above 0. That's positive. We're also seeing a recent extreme negative price and going above 0 based on volume. So that's more intermediate term positive. We're still below 100 with our micro cap index, and they were down in Wednesday's session, but not quite hitting a new 52-week low, at least another one yet. The Heikin Ashi is looking more positive. The Kegi is also looking more positive. We actually have an open block now with the Renko. That's turning more positive, and the 3-line break is also looking more positive. We did see a bit of a bounce with the equal weight index as well as the weighted index for the S&P 500. And we didn't really see a big breakout with the mega caps outperforming the S&P. That could be positive. That just shows that there's more broad participation. The Dow is right on its 200-day moving average. How's that for technical analysis? The diamonds continue to be positive. And we're right up at this previous high now with the NASDAQ 100. Can we break through that? We're above the 50-day moving average. That's positive. But we need to see some more momentum to really take prices higher. The Elder Impulse system for the Qs remains positive. We're also looking more positive with our momentum. The PPO has crossed above its moving average. It's still below 0, but it is showing a lot of improvement. And I wanted to show this. I haven't shown it in quite a while, where the QQQs on a ratio basis to the 3 to 7 year bond, well, we're coming back out of the rainbow now. We're not making new highs at this point, but we are continuing to show some improvement here. The NASDAQ is right above its 50-day moving average. Can it stay above that level and eventually go test this R1 level? The small caps, we are seeing a recent death cross here, even though they've been bouncing back up. They're going to need to do a lot of reparations right now for us to turn back more positive. Looking at the Russell, where it has not generated a death cross yet, we're right about at the 50 level with the RSI. We are showing weakness here looking at the moving averages. We did hold up in this recent support area, and we're showing a bit of a bounce, even though we were down slightly in Wednesday's session. But the MACD is starting to show that the momentum is turning more positive. The Elder Impulse system for the small caps remains positive. The mid caps have not been able to come back up to their 200-day moving average, at least yet. And they still remain positive, though, for the Elder's Impulse system. Looking at our 200-day moving average study for the S&P, we ticked down just slightly, but we're showing some improvement with our 50-period moving average study. Looking at Dow 30, where we saw a bit of a bounce with the Dow, a little bit with the transports, and we're seeing a bit of a bounce with the utilities as bond prices are going up. The FANG index continues to be above its 50-day moving average and still in a longer-term uptrend. Looking at our arithmetic scale, we're still above this red line. That's leaning more positive. The Staples to S&P 500 ratio continues to decline, and that could be giving some good support to the S&P. Looking at some growth to value ratios where the Qs are outperforming the S&P, we did see a bit of a bounce back up with discretionary, and then large cap growth versus large cap value is improving. When we look at our growth to value ratios, pretty much across the board with the large caps, we fell a little bit with the mid caps, turned down just slightly with the small caps, but all three are still above their moving averages. This is still negative, but this is a longer term indicator, and if it's going to improve, it's going to take a little bit of time. This is the 50-day exponential moving average of the new highs minus the new lows. We're still dropping below zero. But now, look at the black line. We spent 2 days above zero right now. The longer we can stay above that, the more chance we have of the red line, which is a 50-day moving average, if that could start to turn back up and actually go positive. The 10-day average of the S&P 500 highs minus the lows after giving an extreme negative reading continues to show some improvement here. The dollar continues to advance ever so slightly. And then it appears that I was off by about a week with our 50-day cycle. When I first calculated this, it came out to October 11th. Well, now it looks like the cycle will begin on October 17th. So I apologize for that mistake. Keeping an eye on bond yields where they are really starting to drop off. And so price is starting to show a bounce. We're turning back positive with the MACD. We're still below 50, but showing some improvement with the RSI. The 30 to the 5 is still back to being normal, where we've dropped slightly below zero with the 10 to the 5 yield curve. And we're still looking at a pretty strong correlation when we compare the 10-year yield, subtract the German 10-year yield, and compare it to the dollar index. Here's Tom Bowley's research, which I finally received, where staples are not hot in the month of October, where the financial sector tends to be hot. We're coming out of this positive time right now, and we're actually starting to come out of this negative time where we're getting more into the middle part of October, where sometimes historically we see positive returns, but then we see some pretty negative returns before going back to positive to end out the month. And this is, I think this is banks at the bottom here, and then we have asset managers, which are different industry groups that tend to do well in October. So what's our outlook for Thursday? The UAW strike is still continuing. They're still trying to decide about the Speaker of the House. And now it's the Israel, Hamas, Hezbollah, Iran war. Now, Iran hasn't officially been declared, at least the last time I was looking at things, but they support both Hamas and Hezbollah, so it's not a real stretch to make that connection. And it's not like Iran and the U.S. are buddies. We've been pretty mortal enemies with each other since 1979. The technicals continue to show some improvement, and we're turning more positive, especially in the short term. And yesterday I was saying, are things starting to fizzle out a little bit? Well, maybe that's starting to go away. Now, we could get a hot CPI report that could freak out the market, and that little fizzle could turn into an actual drip. The economic reports coming out, we will get weekly jobless claims. The big one is going to be CPI. and all of the different geopolitical events that we're keeping an eye on right now. Here's the updated calendar where we will get consumer sentiment in Friday's session. The Stock Traders Almanac for October 12th. We're negative with the Dow, not just neutral to negative. We're negative flat out. Where we're neutral to negative with the S&P and we're neutral to positive with the NASDAQ. So we've got the whole gambit of things to choose from here. Looking at our pre-election year when we have a sitting president who's running for re-election, are we seeing that little bounce? Are we going to see some weakness going into the latter part of the month? Seeing pretty much that same thing with the Carson research, bounce and then some weakness. The NASDAQ, bounce and weakness. S&P, bounce and weakness. Now, it could play out different this time. We just are looking at this as a historical average of what has already happened in the past. Then we're up 10 out of 18 times with the S&P, down 8 out of 18 times in the month of October during pre-election years going back to 1950. And then keeping an eye on Bitcoin, which is going down. So we're not really playing into this green area, at least yet. But the Bitcoin folks are like, no, we're not at the good part yet. We're not ready for Bitcoin to really take off. You can rationalize it any way you want, but we're still continuing to show a death cross here, and we actually are showing a bit of a decline down to its 200-day moving average. Excuse me, that's its 50-day moving average. Maybe it will find some support here and be able to bounce up off of that. So we'll see. So the scenarios, we're not going with the down one now. Now, we could easily switch back to that with a down day, but we're leaning more towards the upside because we have more things that are positive right now than are negative, but we're not going with the sideways trend because both of our ADX charts, even though they're weakening, are still above 20. The warning signs, seasonally and historically, October can be a positive month. Any month can be a positive month, but because we had 1929, we had 1987, and those happened in October, you have a lot of folks that are really gun shy of the month of October. The longer-term equity put-call ratio is continuing to go up. That's negative. The risk-on posture, it's really not moving all that much now, and overall, it's been showing some weakness. The 50-period new high, new lows equal, I always want to say that, exponential moving average study continues to be negative. The Russell is below its 200-day simple moving average, and we're wondering, are we working off of a head and shoulders top? The small cap index has now generated a death cross. Positive, the daily special K chart, it hasn't crossed over negative at least yet. The equity put call ratio continues to go down. The S&P oscillators and the NASDAQ PPO that we watch are turning positive, except for the longer term oscillators that we keep an eye on. The parabolic SAR is positive. The BPI has generated a buy signal after crossing back above 30. The Copic curve is also generating a buy signal. The vortex is right at even. If we see a continuation, it's probably going to turn positive. The Staples S&P 500 ratio is declining, where the S&P 500 to utilities ratio is going up. Those are both positive for the S&P. The Russell and the mid-caps are working off of golden crosses, but they're in danger of triggering death crosses the longer we stay below those 200-day moving averages. Small and mid-cap growth continues to be positive. The financial sector is also below its 200-day moving average, even though it's working off of a recent golden cross. So our conclusion, we're turning more positive now, but we're trying to figure out, is this just a short-term bounce, or is this going to develop into something longer term? Is the fizzle that I was referring to yesterday starting to go away? It could come right back quickly. In the short term, we are positive, but becoming more overbought, or at least extreme positive. In the intermediate term, we are showing a lot of improvement there and turning more positive, and we're still positive in the long term. Thank you. I hope this video was helpful to you. I hope you have a great day, and I will talk to you in the next video.